Are penny stocks, those shares of companies trading under $5 per share, genuinely as alluring as they appear with their seemingly affordable entry point and the allure of substantial gains? Is it true that these shares, which have captivated the interest of budding investors and traders, could potentially lead to significant rewards? However, is it possible that beneath the surface of these seemingly appealing investment opportunities lies a world fraught with colossal risks and potential pitfalls, capable of causing catastrophic outcomes for those who dare to tread into this treacherous territory? In this video, we are going to dig into the various dangers that are linked with penny stocks. These dangers range from the penny stock's poor liquidity and high volatility to the rampant fraud that frequently affects this market segment. Low liquidity. Navigating choppy waters. Penny stocks, often characterized by their low price per share and limited market capitalization, bring a unique set of challenges to investors. One of the most formidable hurdles associated with these stocks is their tendency to exhibit low levels of trading activity, resulting in what is known as low liquidity. Liquidity, in the context of the stock market, refers to the ease with which an asset can be bought or sold without significantly affecting its price. High liquidity markets are characterized by a large number of buyers and sellers, allowing for quick and seamless trade executions. However, penny stocks frequently lack this robust trading environment due to their relatively small market presence. The implications of low liquidity in penny stocks are manifold. Firstly, the limited number of participants actively trading these stocks means that finding a suitable counterparty for a trade can be challenging. This can result in delayed trade executions and often the need to accept less favorable prices than initially anticipated. Moreover, the scarcity of trading volume in penny stocks amplifies the impact of individual trades on the stock's price. Even a small trade can lead to significant price fluctuations, making these stocks susceptible to sudden and sharp price swings. Perhaps the most pressing concern arises when investors attempt to exit their positions in penny stocks that are experiencing dramatic declines in value. In a low liquidity scenario, finding buyers for these falling shares becomes increasingly difficult. It's akin to attempting to evacuate a sinking ship without an adequate number of lifeboats for all passengers. Investors may find themselves trapped in a situation where they are unable to sell their shares at a reasonable price, leading to potential losses. High volatility. Riding a roller coaster of uncertainty. Penny stocks are notorious for their elevated levels of volatility, which refers to the significant price fluctuations that can occur within a relatively brief time span. This inherent unpredictability presents a considerable challenge for investors attempting to gauge potential gains or losses within their investment portfolios. The allure of substantial profits is counterbalanced by the looming possibility of substantial financial setbacks, all stemming from the same price volatility. Investors find themselves in a perplexing situation due to the tumultuous nature of penny stocks. The very volatility that may entice traders with the promise of lucrative returns can just as quickly result in substantial losses. This fluctuation demands a cautious and calculated approach from traders seeking to navigate the intricate landscape of price volatility. Imagine a scenario where an individual invests in a penny stock that experiences an astonishing surge in value over a matter of days, only to witness a precipitous plummet that renders the stock nearly worthless shortly thereafter. This illustration encapsulates the roller coaster ride that investing in penny stocks entails. The innate volatility of these stocks transforms investing into a high-stakes venture, where fortunes can be amassed or squandered in the blink of an eye. In essence, the distinguishing characteristic of penny stocks lies in their propensity for volatility. While the allure of significant gains may captivate traders, the stark reality of potential losses underscores the vital importance of prudence and thorough research. Engaging with penny stocks demands a cautious and well-informed approach, as the landscape is rife with both opportunities and risks. The capacity for dramatic price movements encapsulates the essence of penny stocks, making them a realm where careful navigation is imperative for any investor hoping to seize advantageous outcomes while guarding against potential pitfalls. Fraud and manipulation, a breeding ground for scammers. Unfortunately, the world of penny stocks is a fertile field for con artists and people who manipulate the market. Scammers frequently use the low trading volume and lack of regulation associated with penny stocks in order to artificially inflate stock values and propagate misleading information. This fraudulent conduct typically takes the shape of pump and dump scams, in which con artists promote a stock as the next big thing in the hopes of luring investors who are not paying attention to get involved. When the stock price has reached its highest point as a result of the increased number of buyers, the con artists quickly sell their shares, which results in a drop in price and leaves others who bought in at inflated prices holding the bag. Lack of transparency. Navigating the murky waters. Penny stocks predominantly find their trading ground on over-the-counter marketplaces, distinguished by their lower degree of regulatory scrutiny when contrasted with established stock exchanges. This divergence in oversight introduces challenges for investors seeking comprehensive insights and risk assessment in the realm of penny stocks. The lack of transparency prevalent in these marketplaces casts a shadow over the investing landscape. In comparison to mainstream exchanges, where stringent reporting and disclosure requirements prevail, OTC markets offer a more opaque environment. This opacity hinders investors in their pursuit of conducting in-depth research, evaluating risks, and making informed decisions about penny stocks. Investors venturing into the world of penny stocks encounter a unique challenge: a dearth of regulatory safeguards and standardized reporting practices. Unlike major exchanges, which adhere to stringent reporting and disclosure standards, OTC marketplaces lack a uniform framework. This information disparity translates to investors remaining unaware of the legality of the companies underlying the stocks they trade, as well as the overall financial health of these entities. The murkiness enveloping penny stocks amplifies the potential for fraudulent activities and deceptive practices. The absence of stringent regulatory oversight makes it arduous to discern between legitimate investment opportunities and potential pitfalls. Investors grappling with this opacity confront the daunting task of navigating a market where the lines between genuine potential and fraudulent schemes can be blurry at best. The allure of high returns, striking a balance between risk and reward. Some investors are driven to penny stocks owing to the possibility of spectacular returns. Despite the inherent dangers that are associated with these products, it can be enticing to purchase a large number of shares at a low price and then watch as their value increases over time, as this can be an attractive investment strategy. However, one must approach this temptation with a healthy dose of healthy skepticism. Penny stocks frequently come with the risk of suffering big losses, in addition to the possibility of generating high gains, which can be devastating. It is crucial to note that the alluring promise of quick gains should not obscure the reality of the significant risks that are involved. This is because the risks involved are extremely high. Advice for navigating the dangerous world of penny stocks: perform extensive research. Prior to investing in any penny stock, conducting comprehensive research is an essential prerequisite. This diligence is crucial to mitigate risks and make informed decisions. Several steps can aid in this process. Scrutinize financial statements. Thoroughly examine the company's financial statements, including its balance sheet, income statement, and cash flow statement. Analyze key financial metrics such as revenue growth, profit margins, debt levels, and liquidity. This analysis provides insights into the company's financial health and stability. Review press releases and industry trends. Stay updated on the company's recent press releases and news. Press releases often provide information about significant developments, partnerships, or changes within the company. Concurrently, monitor trends in the industry to understand how the company's prospects align with broader market dynamics. Industry analysis. Delve into the industry in which the company operates. Understand the competitive landscape, potential growth prospects, and any challenges or regulatory changes that might impact the company's performance. This broader context helps evaluate the company's position within the industry. Be wary of scammers making unrealistic promises. Scammers frequently entice naive investors by promising them astronomically high returns on their investments in a short period of time. If an investment opportunity seems too good to be true, you should exercise extreme caution before pursuing it. Due to the volatile nature of penny stocks, investors should avoid risking more money than they can afford to lose by putting their money into these companies. Avoid taking on additional debt or investing money that is already earmarked for important financial commitments. Invest in penny stocks that trade on well-regulated exchanges. If you can, try to invest in penny stocks that trade on well-regulated exchanges, such as the New York Stock Exchange or the Nasdaq. These exchanges mandate more stringent standards, which decreases the likelihood of users coming across fraudulent schemes. Penny stocks may entice investors with the promise of big gains. However, these investments are laden with risks that cannot be understated and should be avoided. Investors who are not paying attention are walking into a minefield with these stocks because of the numerous dangers they provide, including rampant fraud, poor liquidity, excessive volatility, and a lack of transparency. Those who embark into the world of penny stocks without having a solid awareness of the dangers that lie ahead are setting themselves up for a significant loss of capital, despite the fact that the prospect of huge rewards may be enticing. In order to successfully navigate the perilous terrain of penny stocks, it is essential to conduct exhaustive research, practice responsible risk management, and have a comprehensive grasp of the market. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.